Hi, welcome to VCC TV. Modi government has completed a year in power. While there have been reforms by the government, or at least talk about it, many believe that the progress has been slow. The euphoria in the markets is dying and paving way for reality. Some believe that Modi government has been all talk. Even though India is said to be the fastest growing economy in the world, with the government pegging the growth figures at 8 to 8.5%, there are still structural constraints that need to be addressed. But then again, if the government could solve all problems in 1 year, why give them 5? Today we have with us Mr. Subir Gokarn, Director of Research at Brookings India and former Deputy Governor at RBI, to discuss about the performance of the Modi government and the road ahead for the Indian economy. Thanks for coming on the show, sir.
Thank you.
Let's begin with the most intriguing aspect of the Indian economy, that is the pace at which it is growing. How do you personally reconcile the dissonance between the GDP figures and the high frequency data, and what policy implications can it have?
Well, I think we are still not in a position to reconcile these two patterns. The new numbers have clearly told us that the economy is growing at a rate faster than we believed earlier based on the old series. But we don't yet have a time profile, a time series of data according to the new methodology, which allows us to to gauge whether we are at what stage on the business cycle, what stage of the business cycle are we, is the economy in under the new numbers. So under the old numbers, we were very clear that the economy was slumping till perhaps last year sometime, and then it bottomed out for a while and it started to pick up again. The new numbers tell us what's happened in the last 3 years, that there's been acceleration, but we cannot put this in the context of any historical pattern which would tell us where we are in the business cycle. So I really am not, I think based on any technical capability or technical capacity, not in a position to make a comparison. I have no doubt that the methodology used for new numbers was genuinely intended as an improvement, using a larger array of numbers representing a larger part of the economy, a larger proportion of the economy. But I don't have a comparative framework here. So I would like to know, under the new series, what was the economy doing, say between the period 2003 and 2008, when we know that under the old series there was very high growth. So if we have that, maybe it was 12%, maybe it was 13%, I don't know. Then we're able to say, okay, is the economy in a cyclical downturn with a recovery or not? But until we have that back series, to me this is a somewhat a futile debate.
1 year ago, India was the toast of the town amongst the emerging market economies. People even drew parallels to an elephant adding wings to take off. Is the current optimism in the market a reflection of that?
Well, markets tend to be a little bit ahead of the real economy. That's typically been the pattern. Even in situations where you had serious recessionary tendencies, markets have typically recovered about 6 months to 9 months ahead of the real indicators. So one could see this optimism as being a precursor to recovery in the real economy. But we also have to be cognizant of the barriers that there are to not only recovery, but also beyond that sustaining rapid growth. And to me, the key barrier in the Indian context is infrastructure. Markets can make whatever assessment they want, but when you look at what is preventing businesses and entrepreneurs and farmers and so on from expanding their output, which is what you need for growth, I think infrastructure really imposes a very, very serious constraint on this capacity. So we can certainly see some growth, but I don't see a takeoff when you're using the sort of wings analogy, unless we provide some really substantial solutions to our infrastructure problem.
Now, the failure of the government to build a political consensus in Rajya Sabha is somewhat similar to policy making in the United States, which is stuck due to partisan politics. Did the analysts and the investors not take into account the government's ability to maneuver through Rajya Sabha, given the minority? And how can it stall the big moves?
Well, I think a good analyst would never have discounted this prospect. A good analyst would have taken into account the risks of the government not being able to put together a majority in the Rajya Sabha. So to say that analysts didn't take into account is only saying that they weren't good analysts, which I think is a sweeping generalization which is difficult to justify. I think the issue is that there are two issues here. One is the government itself is literally it is backtracking, because the BJP did support the land acquisition bill in the previous parliament, and so now it has to make a much stronger case for why it is, having supported it then, why is it looking to change so quickly. So I think it has to provide assurances as to how those changes will not hurt specific interests, how those changes, they may help some interests, which is what the opposition is accusing them of, but there isn't a strong enough counter argument which says that they will also actually help the interests of people who the opposition claims it's hurting. So I think you have to build your case. This is not a question of confrontation or domination. That could have happened had the ruling coalition had a majority in the Rajya Sabha as well. It's really a question of chipping away. It's really a question of trying to one by one persuade members of the opposition that there is benefit in it. And that means being somewhat more explicit about how these benefits might accrue. What are the other things the government is doing to ensure that these benefits might accrue to the targeted constituency, whether it is farmers or landless labor or whoever it is. If that is the perception is that they're going to lose out from this, then it's politically very difficult to get this bill passed. But if the argument is, well, there are some consequences, but we are doing various things to mitigate those consequences, and here's how we plan to do them, then you have a better chance of seeing it through. So I think that has to be the strategy: is to just look at the various points of opposition and try and counter them either with the contents of the bill itself, or by citing indicating other supporting elements of the ecosystem which will help to mitigate those costs. And in fact, not just mitigate them, but also to ensure that those interests are actually being advanced by this. So is it in the form of jobs? Is it in the form of compensation? Whatever it is, but you need those assurances.
Although the global crude prices are still lower than the level that they achieved last year, but the retail prices have started rising, and the low price cushion and the effect of inflation has waned off. What do you think would happen once prices start getting up? And what would be the impact of El Nino effect or US Fed rate rise or the crude prices rising on the Indian economy?
No, I mean, there are two separate issues here. One is you're asking what the impact would be. That is a hypothetical question. If, for example, El Nino does happen and the monsoon fails disastrously, it would obviously cause a lot of distress. But let's look at the baseline. What is the baseline scenario in the El Nino instance? And each of them has a baseline and then a worst case. For El Nino, the baseline is that the current projection for the monsoon is 93% of normal. Now, 93% of normal is not a crisis situation. The severity of the problem will depend entirely on the regional distribution and the temporal distribution, the time and space dimension of the monsoon. So if the monsoon is relatively weak in some parts of the country, particularly the west coast or the north, the impact on food production and prices is limited, because these are even a subnormal monsoon on the west coast provides enough water for cultivation. In the north, even if you don't have that much rain, you do have the snow melt feeding the irrigation systems. The real vulnerability is in the central part of the country, which is not only completely dependent on rainfall, but the normal rainfall is just about enough to sustain agriculture. So there you see an impact on pulses and oil seeds, on cotton, And that can have some inflationary impact on food prices. But 93% to me is not a panic situation. Now, of course, El Nino is a phenomenon. It has a relatively high probability of impacting the monsoon adversely, but there's no guarantee that the monsoon will fail. So I think we've got to, instead of anticipating a crisis, now we've got to wait and watch and see how it plays out. But to me, the baseline right now at 93 is by no means, crisis or a borderline panic kind of situation. On the Fed, if the Fed were to raise rates in 2013, they didn't eventually do it when they said they would, but even the anticipation of it, even the fear of it caused so much disruption. Today, they've actually been raising, they haven't raised the rate yet, but they've rolled back the liquidity, and it's had no impact at all. The key difference between then and now is the size of our current account deficit. I think it would make a very general statement, a very strong assertion, that if our current account deficit is where it is today, which is roughly around 2% or slightly below 2% of GDP, I don't think we have to worry about what the Fed does. Our vulnerability is contained. If it goes up to 4%, in fact in 13-14 it's 4.8%, then we have a serious problem. Even a small shock from outside can magnify into a full-blown currency crisis. Having got the current account deficit down, I think we're relatively safe on that front. Oil prices, we've seen them go back up from their troughs clearly, but shale is a looming substitute. We already are seeing significant shale production in North America, shale and tar. The economics of shale roughly suggest that around $65 a barrel will keep it viable. Much of the shale reserves are extractable profitably at $65. So it does impose some sort of a price cap. So even if we see the prices going up again, since as we have, I think in a sort of again a baseline scenario, I don't see them going up very sharply beyond this level in the short term. Longer term, of course, there are all kinds of risks, and who knows where it can go. But I don't see this as a reason to be terribly worried in the next year or so, next year to 18 months.
Now, talking about agriculture, we've seen farmer protests all over the country. Has the government accentuated the agrarian crisis by not increasing the MSP and reducing the quantum of? I
think this is one of the most misplaced and concerns that I've ever heard. The MSP is a great boon to somebody who's growing rice or wheat, because those are really the only two products which are purchased under the MSP framework, the procurement framework. But in doing that, by incentivizing farmers to produce more and more rice and wheat at a time when the country's consumption patterns are changing, you actually aggravated the food inflation problem. Farmers are producing more and more rice and wheat because the government is offering them more and more money to grow this. That's ending up in stocks because this is not being consumed. And then you're taking up land that could be used to produce other things, whose prices are rising because people are consuming more of them. And that has been compounding, that has been contributing to our problem with food inflation. So to say that the farmers' distress, I think, is completely ignoring the whole consumption side of the story. There are consumers also. Why do people talk about farmers as though this constituency is somewhere above and beyond the rest of us who are consuming food and paying higher and higher prices for things that we want to eat because the farmer's MSP is so high? So I think we have to find some balance here, some proportion here.
What is your view on RBI's monetary policy strategy? While there is a clamor in the market for a rate cut, rising inflation also poses a serious problem. Do you think RBI still has room for more rate cuts?
Well, I think the RBI's judgment is based on its assessment of inflation risks. If it believes that inflation today is not normal, if that there is a prospect of it rising and rising fairly sharply for whatever reason, maybe it is El Nino, maybe it is something else, then there is a rationale for not reducing rates. If on the other hand it believes that inflation has stabilized, the risks of a turnaround, an upsurge in inflation are relatively low, then it clearly has enough headroom to cut rates. Now, what sort of benchmark should we be using? I believe the governor at some point has indicated that somewhere around a 1 to 1.5% real rate is a reasonable stance. It is a neutral stance. And if that's the case, then with inflation at 5 or so, last month CPI was slightly lower, 4.87. But at 5, if this is a sustainable level, then the repo rate by that benchmark should be around 6.5. So that would give you the extent of headroom that the RBI has if it believes that inflation is going to remain stable. So it's not really a question of certainties here. It's a question of what the assessment of inflation risks are, whether inflation is going to go up again or is it going to stay roughly at the current levels. If the latter is true, then obviously there is room to cut.
Now, the recent trend in the stock market has thrown up two views. One is that it was a dead cat bounce, and the other that the market has hit the bottom at this point of time. Looking at the macro fundamentals and the near-term outlook on the economy, which view would you like to support?
I really think that the constraints to growth, to sharp acceleration are key to this. And there we have actually, stories or arguments on both sides. Clearly the moderation of inflation is creating headroom for an interest rate stimulus, whether it happens now or later. If inflation remains more or less at current levels, somewhere along the line interest rates will go down. That is going to stimulate some consumer spending, particularly durables and some which have been quite sluggish. Construction will be stimulated. So those are all factors that will provide some momentum and some sort of reinforcement of what is already a sort of a mild recovery, you could say at this point. But on the other side, the ability to break out of the range, I mean, we had a discussion of old numbers versus new numbers, so I'm not getting into numbers here, but break out of the current growth range, I think is completely constrained by infrastructure. So I don't see how the market can keep rising without some assurance, without some visibility on those bottlenecks being dealt with. Looking for credible, concrete, fast moves on easing the infrastructure constraints in whatever way across the board. The solutions are not going to come overnight, but as long as you see movement, I think that should support market optimism. If that movement is not visible for some time, then I suspect that the optimism will start getting tempered. So I think it's really in a balance situation right now. There are some prospects for acceleration, but there are also constraints that need to be taken into account.
Another view is that willy-nilly India is the better placed economy amongst the BRICS counterparts. What do you think about that?
Well, certainly Russia, Brazil and South Africa are relatively commodity dependent. The health of their economy is very significantly impacted by commodity prices, Russia in particular, but both Brazil and South Africa are big commodity exporters, not so much oil but other commodities, and commodities by and large have softened. So you can see from their growth numbers that things are not looking very bright, and that is the inevitable consequence of commodity prices. China and India are the two commodity importers, so commodity price dynamics have actually worked in their favor. Now China is going through a transition which is obviously bringing its growth rate down, but I don't think we should underestimate the sort of the sturdiness, the robustness of the economy at this point. And so I would say that India certainly is, because it is a commodity importer and because there is hope that the government will push ahead with the reform agenda, is offering a very good proposition to the global investor. But that doesn't mean it's the only one. It may well be amongst the most attractive, but let's not underestimate China's attractiveness. Now, for that matter, there may be some other countries also in the mix. But I think that within the BRICS context, it's the commodity exporters versus the commodity importers, a very sharp divide between the two.
Now, coming to the question of capital account convertibility, Do you think India should go for rather full capital convertibility or fuller?
Again, here I think somehow there's a tendency to see this issue in terms of black or white. You're either convertible or you're not. And to me, the issue is, it's really a sort of rather trivial point. And of course, full convertibility means that there would be no restrictions on anybody's ability to bring money in or take money out. And that may sound like a very ideal situation, but there are obvious risks that come with it. Now the question is whether as a system we have the capacity to bear those risks, and if we don't, then we have to be cautious and say, well, okay, let's not get carried away with this idea of full convertibility. Let's just sort of cut the coat according to the cloth, as they say, and look at our domestic institutions, our financial system, regulatory framework, risk management frameworks, and say, well, there's a certain amount of risk we can take, and we should limit ourselves to that. So I have to me, it's not an issue of principle that you should have full convertibility or you should have partial convertibility. I think you should have convertibility is good. It brings with it a number of benefits, but in excess, beyond your capacity to deal with it, it can make you very fragile. And I think where we are in terms of our priorities, relatively full convertibility on equity investments, certainly full convertibility on FDI, limited convertibility on Indian citizens being able to take money out, but it's substantial. It's not trivial. And some limits on debt inflows, particularly on short-term debt inflows. I think that's a reasonably prudent combination of restrictions that we have. So it's not, to me, an issue of great significance.
Coming to the last question, looking at government's agenda for the year, what are the top 2 or 3 things that you would say that the government should do going forward?
I think I come back to a theme that I've been repeating right through this conversation, which is that if we don't get a credible infrastructure strategy, in place, growth is not going to come back, because our entire economic activity, the spectrum of economic activity, is constrained by infrastructure. It is partly sector specific, it is partly coordination across sectors. So it's not just a question of dealing with roads or dealing with railways or dealing with power or dealing with ports. It's a question of ensuring that whenever there is an increase in some capacity, the other capacities around it also grow proportionately. To give you a very concrete example, although coal is strictly not infrastructure, we had a massive expansion in coal-fired generation capacity over the last 5 years, but we saw no increase in coal. Now we're struggling to, obviously a process has started, but it's still going to take some time for that to translate into actual increase in output. But for all that time now, these power plants are basically operating at suboptimal levels, which is then having an impact on the banking system, because banks have lent money to these plants and they're not able to service their debts. So this is the story across infrastructure. There's a problem with infrastructure, projects are started and stalled, and that has put an enormous burden of non-performing assets on banks. So the combination is actually proving to be quite negative, strongly negative for the rest of business, because if banks are struggling so much with their non-performing assets from infrastructure, they're very reluctant to lend to anybody else because they cannot take on that additional risk. So it is a sort of a problem of massive consequences and on multiple dimensions. So if we don't address infrastructure, a lot of other problems are going to become more and more severe. I think we cannot afford to let that happen.
That's about it, sir. Thank you. Thanks for your time.
Thank you.